Well, hello, good morning. This is Cozy. I'm gonna have to start by apologizing because I'm wearing really dangly earrings, so I'm gonna look a little bit robotic because I've been told they can interfere with the mic, and I might have to take them off mid-speech. Let's see how far we get. So, I'm Sophia. I work at Citi in Canary Wharf, so pretty much down the road. And I work in a part of the bank called the Citi Institute. It's our thought leadership division. I'm a research analyst there, and I publish reports and thought leadership papers on anything and everything to do with the future of the industry that I work in, with the future of finance. I'm a research analyst there. I don't cover equities, I cover themes. I think I'm going to take them off. And today, I'm going to give you the key insights from two reports that we published this year on stablecoins. They're up there on the slides. If you want to download them, you can take out your phone now. And yes, great, some people are taking out their phones. Love it. Brilliant. You can download them. It's got all the details in there, including my contact details, my email address, in case you have any questions, comments, criticisms. We actually love it when people disagree with what we say. So feel free to reach out. Now, before I give you the key insights of the reports, maybe just to address one thing up front, because it's quite topical. Many of you will have seen the media announcement, I think it was on Friday, with various banks getting together, including my bank, including Citi, to explore stablecoins, both euro-denominated and dollar-denominated. I'm not going to be talking about that. We have different people in Citi that operationalize and implement Citi's stablecoin strategy. I'm purely on the research side. So also that piece is not covered in the report. So I'll talk to you a little bit about why stablecoins matter, our updated forecasts and market sizing, how they fit into the broader on-chain money ecosystem, some key use cases, challenges, open questions, and that's about it. Those are the key points from our reports. So every thought leadership piece that we do, including these two, they always start off with the why now questions. Why do stablecoins matter for us now? Why did Citi decide to put out two reports in a very short space of time? Well, what we say is that we see 2025 as a kind of inflection point, what we in the report called blockchain's ChatGPT moment for institutional adoption. So what do we mean by that? Well, just as generative AI has catalyzed a leap in mainstream adoption of a disruptive technology, we believe stablecoins are pushing blockchain into the core financial infrastructure because of various factors. One, we're seeing a huge surge of announcements from digitally native firms integrating stablecoins into commerce, payments, and real-world applications. It's particularly interesting when you look at what the big e-commerce players are doing, like Shopify or eBay or Expedia. They're not necessarily issuing stablecoins, but they're partnering with the wallet providers to accept crypto and stablecoins and to allow merchants to accept these digital assets so they don't have to rely on more expensive cars and to, of course, appeal to crypto-friendly sellers and buyers, and for a range of other reasons. So that's one factor. The second one is the significant growth in issuance. Already, stablecoins have grown 30x in the last 5 years, and they've already grown quite a lot, and we have the figures in the report from the beginning of the year. So that's the second reason. Then the third reason, in terms of the why now, is the evolving regulatory tailwinds and regulatory momentum. I'm sure you heard a lot about it over the last couple of days here with the Genius Act. And the final reason is the offshore international demand for holding USD. The spirit that we've captured in both reports is that this time it's different to where we were in the past with digital assets. I think all these trends signal that stablecoins are shifting from a niche decentralized finance experiment into something viable, a viable rail for moving money. So maybe we can make this a little bit interactive because I feel kind of lonely on stage. My colleague was meant to join me here. He couldn't make it. Maybe by show of hands, you can tell me, sort of raise your hand if your institution is actively exploring stablecoins in some shape or form. Anyone? Yeah, that's a fair amount, actually. It's kind of what I was expecting from this audience. So that was the first thing. Why now? Then let's talk a bit about forecast and market sizing to 2030. Being a bank, putting out a research report, obviously we had to put some figures to it. It's also the figures that make the headlines in the press for us, which we like. So what we did in our second stablecoin report, the second one I had with the QR code up, we revised our issuance estimates. We raised them. Basically, for the reason we did that is the answer to the why now question that I just covered. So the base case, we said $1.9 trillion, up from 1.6 from the previous report. The bull case, which really made big headlines, was the $4 trillion, up from 3.7, and the bear case is 0.9 trillion. But issuance is only part of the story with the figures we have in the report. Because stablecoins and all on-chain money move broadly, they can circulate with really high velocity, and they support very high velocity transaction volumes. And again, we have figures for that in our report. In our base case, we estimate $100 trillion in annual transaction volumes for stablecoins, again by 2030. In the bull scenario, we double that to 200 trillion. Of course, even with that scale, it's worth noting that really large banks, including ourselves, move somewhere between $5 to $10 trillion in fiat today, per day. Then we also model a regional breakdown. Much of the growth, we say, will still be US-denominated stablecoins, particularly offshore. But we also expect local currency stablecoins to thrive in certain jurisdictions and certain markets that embrace digital innovation. For example, Hong Kong and the UAE. So that was the second key takeaway from the reports, the numbers. The third piece is we talk about all the different types of digital assets, stablecoins, tokenized deposits, deposit tokens, CBDCs. I'm sure you all know what these are. We explain their properties. And the takeaway from both reports is that stablecoins are not going to be the only game in town. They're going to exist, and they're going to compete alongside other types of digital assets. This isn't particularly new. This has been the Institute's party line when it started writing about blockchain, actually, well before I joined the Institute 4 years ago. So we envision a multi-format monetary ecosystem with different types of digital assets being used for different things, finding different product market fit. And we explain that in the report. But we think, having said all of this about stablecoins and the issuance numbers and velocity numbers, in our view, bank tokens, be that tokenized deposits or deposit tokens, will outpace stablecoins in transaction volume by 2030. Next up, we talk about some use cases and implications for corporates, for financial institutions. We also softly talk about geopolitics as well. So first up, for corporates and for treasurers, we explain how they can optimize liquidity management globally, how they can reduce friction costs, and we explain their value add, namely being programmability, embedded compliance, and conditional settlement. Again, having said all of this, what we find when we speak to corporate clients, especially very large corporates, is that, yes, they're interested in knowing more about stablecoins. They are not using them now. we think they are likely going to prefer bank tokens and tokenized deposits because of their risk appetite, because of regulatory considerations, and this is something they know, they're familiar with, they can easily integrate with, and of course they already enjoy the benefits of speed with instant payments that you have in various different markets around the world. I think it's 87. So that was corporates and treasurers. Then we talk about financial institutions and markets. In our first report, we talk about all the different roles a bank can play when it comes to stablecoins, be that facilitating the pay-ins and payouts, be that custody, or even issuance. It's an option if that makes sense. We explain the risk of deposit disintermediation, and we also talk about how they can open up the whole narrow banking issue again, so narrow banking 2.0. Finally, we talk about the geopolitical piece, the dollar dominance extensions, stablecoins, especially the dollar-backed, how it can further entrench the dollar's footprint, especially in emerging markets or markets with high inflation, Nigeria, Argentina, Turkey, so on and so forth, whilst at the same time you have other countries trying to de-dollarize. We also explain how you have the two largest players holding a rather large chunk of US Treasury reserves. I think it's about 150 billion, something like that, which is more than some countries hold, like Germany, and we explain the implications of that. And then finally, we talk about the challenges and the risks. I think no report would be complete without that. We talk about the regulatory environment with MiCA in the first report, and the Genius Act, actually we covered in both reports. That's all well and good, but I think there are multiple regulatory loopholes that still need to be filled. I think this is only the beginning. I know something that's very topical at the moment is how regulators and policymakers are going to deal with global multi-stablecoin issuance. We talk about the risk of interoperability and fragmentation and how that needs to be solved for, and reserve transparency, auditability, and backing quality of the reserve asset. That's it pretty much in a nutshell. Maybe I will end with another poll. I mentioned that we think that there will be far more demand for bank tokens and tokenized deposit tokens that will outpace stablecoins. Do you agree? Do you think there will be more demand from that? Hands up if you agree. About 50%, half-half. So for those that raised their hands, well, yes, you agree with us, you agree with our base expectations. For those that didn't raise their hands, I also agree with you, because the future is uncertain. That's all from me. I hope that was useful. Feel free to reach out to me. Like I mentioned, my email address is in both reports, or you can connect with me on LinkedIn. I'd be really interested to hear your comments, your views, any questions. And like I said, we actually like it when people disagree with us, so feel free to reach out with your challenges too. Thank you.